Paying the mortgage off early or investing into the market, this is one of the most debated financial topics today. This has become more true as rates have surpassed 7%, which hasn't been seen in decades. And on top of that, housing prices are up 30% in over the last 3 years. I'm going to make it clear why you should always be investing into the market over paying off your mortgage, no matter the interest rates, especially if you're in the United States. Many arguments are made about why you should pay off the mortgage early. The savings on the interest rate, the increased cash flow, which will enable you to pump extra money into the market to make up for lost time. And the one that everyone goes back is the peace of mind of owning your house outright. Owning your home outright can seem like an enticing idea, especially if you do it early. But before you get to a paid off property, you have to face a lot of American struggles along the way. Before we talk about those struggles, I want to give a quick breakdown of the possible interest savings if you do pay off your mortgage early. The average value in America today is roughly $420,000. A buyer usually puts down 15% as a down payment in cash, which will be roughly $63,000. Most buyers will take a 30-year mortgage, which today is about 7% interest rate. Thanks, Jay Powell. Over the lifetime of the loan, you'll pay a total of $855,000. Of that, $500,000 will be interest, which is more than the sales price of your home. So, of course, you'll want to pay the mortgage off early, right? We are talking about trimming down $500,000 in interest. That's real money. But how does that compare to investing in the market? Well, that's pretty easy to look at. The average return of an S&P 500 index is approximately 10.25% per year. This is without taking inflation into account. If we add inflation, which has been roughly 2.5% a year, that means that our S&P 500 investments will only have a return of 7.75% per year. Is all that craziness of the market worth it for an extra 0.7% return? Most would argue that it's probably not, but that's not the only problem. The journey to a mortgage-free home is long and full of making extra payments into the mortgage can at first seem like the right idea, but it locks up your money into the home. It becomes illiquid and harder to pull out. It takes away from the flexibility. I know what you're thinking. I should really give this video a like and subscribe to show my appreciation, so I'll make sure you do before you forget. But what you're really thinking is, but I can do a cash out refinance. I can take all that money out just by paying some fees. This is what a lot of people thought during the 2008 financial crisis. They had a HELOC or a home equity line of credit as a safety net. But once the financial crisis was underway, many of the biggest financial institutions pulled these lines of credit. Doing a cash out refinance was not as simple as paying some fees. Many people lost their jobs, and banks aren't going to let you do a refinance with no job prospects. This compounds the problem. If you work in the beautiful US of A, we face a lot of challenges other first world countries don't. We don't have the same worker rights of other first world countries. 40% of Americans experience at least one layoff in their career, and 1 in 4 experience 3 layoffs in their career. Layoffs don't just happen in catastrophic events like the 2008 financial crisis. Over half of the states in the great country of America are right-to-work states, meaning that you could lose your job at the blink of an eye. Any reason your employer wants could mean you ending up in the unemployment line. We've seen a move away from union work, which offered a cushion from nonsensical layoffs. Now you're at the whim of a faceless corporation. And if that corporation needs to boost its company's profits, laying off is the easiest way for them to do it. Regardless, if you're laid off, there's still someone who wants to get paid at the start of every month. Your mortgage company, they don't care if you've been making extra payments towards your mortgage. They still expect you to pay on the first of every month. If you become delinquent, then they will start the foreclosure process and they will remove you from your home, no matter how many extra payments that you've made. You can plead with them, but big institutions aren't really known for showing mercy, especially in America. Welcome to America. So now you're thinking, okay, I just have to survive a couple layoffs. That's not that bad. It's just only a small step back. Then I can pay off my house and I'll have the increased cash flow and I can invest oodles of money into my retirement. I could just take my $500 and the principal payment and put it towards my retirement account. I'll be fine, right? Well, it could work out like that, but more likely that it will go this way. The median age of a first home purchase in America is 35. If we take our example, above, it took you 19 years to pay off the mortgage, which means you'll be about 53 and a half when you start your investment journey. Plenty of time to invest. That sounds great on paper, but you gave up one of the most important factors when it comes to investing. This one factor can't be bought or brought back. Can you guess what it is? That's time. Time is the most important part of the equation when you invest. With enough time, you can come back from any market downturn and get the investment return that you want. But now you're starting to invest at 53 and a half, and you're going to be facing a number of challenges. Sure, it would be great to work for another 20 years and invest during that time. If you do invest for that long, you'll end up with almost $2.1 million at the age of 73 and a half and a paid off home. But unfortunately, you work in America. And if there's one thing that America dislikes more than universal health care or free college, it's old people in the workplace. Old people at the end of the pay bands who've fallen behind. Old people who don't put up with unfair work-life balance. Old people who stand up for themselves and don't do unpaid work. This is where corporations see room to cut. Why pay one old person when you can get 5 fresh out of college graduates eager to please? College graduates won't say no. Stay way past closing time and be happy about it. The number one reason Americans retire in America is because they get fired or forced to take a severance. The average age of retirement in America is 62, but not because they want to. A USA Today article cites surveys from the Employee Benefit Research Institute and Transamerica Center for Retirement Studies that says that almost 60% of Americans don't get to retire when they want to. They are forced out of the workplace and into retirement, whether they're ready or not. So your dream of investing for the next 20 years has less than a 40% chance of happening after the age of 62. The chances of getting fired increases the older you get. Ageism is well and alive in the American workforce. This doesn't lend well to the peace of mind that you were hoping for. If you did pay your home off by 53, that means you have 9 years to get your retirement into shape to last you for the rest of your life. But 9 years will not be enough to cushion and build a life that you want to by investing. An investment timeline of under 8 years has a 70% chance of working well, which sounds great, but the other 30% of the time could mean a significant downturn to your investment account to the tune of 30 to 50% market downturn, as big as the financial crisis or the pandemic. And this could spend several precious years that you don't have. If a downturn happens in the middle of your investment journey, chances of you reaching retirement are low, but your chances of facing ageism and getting fired would be astronomically high in a market downturn. So what's the solution? Well, that's easy. Investing in a brokerage account. Investing that extra $500 a month into a brokerage will allow you free access to cash whenever you need off. Facing a layoff? That's fine. You have a brokerage account that will keep you afloat while you look for a new job. Laid off because of your age for a newer college graduate? No matter, you've been saving for 20 years into your brokerage account and have plenty of money to pay for your mortgage and everything else. By investing in index funds over the middle of your career, you are saving yourself from any of the above disasters and headaches along the way. Investing the $500 in your brokerage account will allow it to compound at nearly 10% over the coming decades. This will mean approximately $100,000 in 10 years and almost $375,000 in 20 years. But what if you don't want just money and investment and still get the urge to pay off your mortgage later in your career? Well, the option is still there. At around year 17 of investing in your brokerage account, you can cash it out and pay off the remaining balance of your mortgage. Or if you want more flexibility, you can start withdrawing your monthly mortgage payment from your brokerage account and make the payments that way. If anything catastrophic happens in your life, such as the job loss or health crisis, you'll have an enormous amount of money that you can withdraw without any penalties. A brokerage account will offer you the peace of mind you've always wanted. Thank you for watching the video. If you have any questions or disagree with me, make sure to leave a comment below. If you enjoyed this different take, make sure to subscribe.